So today we are talking about day trading, and this is going to be like a guide to what exactly day trading is, and hopefully by the end of this video you're going to have decided whether or not day trading is for you. Now I have a camera that's at like 1/4 battery and a lot of information to cover, so I'm going to try to breeze through this without spending so much time rambling on as I'm known for. But anyways, let's get right into it. So what is a day trader? Well, there's generally two different groups when it comes to day trading. You have a pure day trader, and this is someone who buys and sells stocks and ends the trading day in cash with no open positions. So they do not hold any positions overnight. Throughout the trading day, they sell everything they bought that day, and they do not carry anything over off market hours. Then you have a swing trader, which is somebody who holds positions overnight and generally for several days, possibly maybe like 2 to 5 days, maybe one trading week is about how long you'll see a swing trader hold positions. Most day traders are a combination of these two things. So depending on the stock or the investment, they are going to be holding it for a couple of days, or they're going to trade in and out of that stock within the single trading day. So how do day traders trade? What do they actually do? Well, first of all, they use professional high-frequency trading platforms. They use direct access brokers. They use very high-speed internet connections, so you're not going to see them using like a library internet connection to be day trading. They have very sophisticated setups. They have the best possible internet connection you could have. They also have the best possible trading platforms and the fastest possible trade execution, because you have to realize as a day trader, even a couple second delay could cost you hundreds or thousands of dollars. So they want to have the fastest possible trading systems available. And they also use a multiple monitor setup, so they have a lot of different charts and things on the screen that they're keeping track of throughout the day. Now they trade based mostly on technical stock analysis, which is the charts and data. And day traders have little or no concern with company fundamentals. So you're not going to see day traders reading company earnings reports or worried about the fundamental strength of a company. They're caring about the volatility of the actual stock and what the chart is doing and what they feel the stock will do based on chart momentum indicators and other technical indicators. So basically what a day trader does is they're using charts and technical indicators to determine the patterns of the stock, the volumes of the stock, as well as the price movements of the stock. And common technical indicators that day traders use are resistance and support levels, moving average convergence divergence or MACD, simple moving averages or the SMA, volatility, price oscillators, Bollinger Bands, candlestick patterns, and RSI, which is your relative strength index. Now, I'm not saying that you guys shouldn't use these indicators if you're not a day trader, because I am not a day trader. I am more of a long-term trader, but I do use basically technical stock analysis to determine the optimal entry point for a stock. So I think it's very valuable to understand both technical and fundamental stock analysis, so you can kind of use a blended strategy. So it's not a bad idea to study technical stock analysis and technical stock indicators, but I don't think day trading is for the majority of people who are looking to get involved with trading. In fact, I wouldn't recommend it to anybody, and you're going to see why when we talk about the success rate of day traders. So, day traders utilize something called leverage. And what that means is that day traders trade in a margin account to increase leverage on a position. So high trading volumes, because they're trading in and out of stocks mostly on a daily basis, they're racking up a lot in commission costs. And as such, you have to offset that commission cost in order to make a profit on an investment. So most day traders need to borrow money in order to make a profit. So what they do is they trade on margin, which basically means that they're buying an asset where the buyer pays only a percentage of the asset's value and borrows the rest on an interest loan, just like you're getting a loan from the bank. Now, margin trading is an entirely different animal, and it's something I do not do. It's a way to get yourself in a lot of trouble, in my opinion anyway. You're going to talk to some margin traders that say it's the way to go as a beginner. I wouldn't recommend it to a beginner. I will never margin trade myself. If I don't have the money to front for the investment, I'm not going to be investing in that. Anyway, so here is the basic day trading strategy. So most day traders make money on relatively small price movements in liquid stocks. So those are stocks that trade at high volumes with mid to high volatility. So in order for a day trader to make money on a day trade, there has to be some significant or at least noticeable price movement with that stock. So if the stock doesn't change in value much throughout the day, if it's a low volatility stock, you're not going to see many day traders trading that stock. But if there's a mid to high volatility with that stock and it's going up and down quite a bit throughout the day, maybe like a tech stock or a biotech stock, things like that where there's a high amount of volatility, that's where you'll generally see more day traders, because you need a price swing in order to make a profit. Basically, higher volatility equals higher risk, and the higher risk equals greater price movement or swing potential. And then lower volatility is lower risk, which means there's lesser price movement and swing potential. So they're in the higher volatility, high risk stock area because they need those drastic price movements in order to make money. Okay, so day traders plan the trade, at least good ones anyway. The failures, they may not be planning their trades, but a day trader plans the trade. What they do is they decide on an entry point for the stock, they decide on an exit point for the stock, and they also decide on a stop loss point, which is where they say, no matter what, I'm cutting my losses if the stock falls to this value, and I'm calling it a day. That way they can try to minimize losses. Some trade 1 or 2 stocks a day, and others trade a small handful of stocks each day. It depends on the strategy and how experienced they are. And some very experienced day traders may stick to 1 to 2 stocks because they know those stocks very well. What they're essentially doing, successful day traders learn the personalities or the volatility of certain stocks under changing market conditions. And once they understand basically what that stock does under market conditions, they can trade those price movements and make small profits. But because they're leveraging their money, they're actually larger profits than you would have had if you were just buying those stocks outright. So that's basically the strategy of a day trader. And now let's talk about the success rate of a day trader. So this was from Investopedia. They said that they estimate that roughly 10% of day traders are successful and 90% are unsuccessful, so they're losing money. So only 10% of day traders actually turn a profit when they're day trading. So if you're looking to get involved in the stock market and you're a complete beginner, I would stay as far away from day trading as possible. But I would definitely recommend learning about the technical stock analysis and learning about technical indicators and learning about candlestick charts, because that's very valuable to know that. But as far as day trading and trading at high volumes and trading in and out of stocks within a day, I would leave that up to the professionals because it's a very small group, those 10%, who are making profits doing this. So I got a couple other things I want to look at here. So this would be people who fall under the successful day trading category, the 10%. These people study the personality of a stock or a few stocks. They identify exit and entry points. They execute in a sophisticated trading platform. They watch multiple technical indicators to predict price movements. They sell as soon as they reach the planned exit point. They also cut losses as soon as possible, and they trade without emotion. Okay? Now, as far as the 90% go, which is the majority of us, or the unsuccessful day traders, these people generally will trade any stock, so they don't have a criteria when it comes to day trading. They will buy on impulse and sell out of fear. They watch too many indicators, so they're keeping track of way too much, and they fall into information overload, or where they're finding information conflicting with other information they're looking at. They also will have no plan for the trade, so they don't plan an exit point. They don't plan a stop loss point. They just buy it and go, okay, hopefully it goes up. And that's where they end up losing a lot of money because they don't set a point to just cut your losses and call it a day. They will ride winners into losers out of greed, so they'll be up on an investment and they'll say, well, maybe it'll go up more tomorrow. They'll hold the stock overnight, and after hours, maybe it goes down. So they don't have a plan like a successful day trader does. And they also largely trade based on emotion. And then the last thing I want to look at, I actually have the SEC/FINRA rules regarding day trading because there are a few things that you have to know. So basically, the Securities and Exchange Commission refers to day traders as pattern day traders. So I'm reading this is right off of the SEC.gov website, so you guys can find this on your own if you're looking for it. But FINRA rules define pattern day trader as any customer who executes 4 or more day trades within 5 business days, provided that the number of day trades represents more than 6% of the customer's total trades in the margin account for the same 5 business day period. This rule represents a minimum requirement, and some broker-dealers use a slightly broader definition in determining whether a customer qualifies as a pattern day trader. Customers should contact their brokerage firm to determine whether their trading activities will cause them to be designated as a pattern day trader. Now, a broker-dealer may also designate a customer as a pattern day trader if it knows or has reasonable basis to believe that a customer will engage in pattern day trading. For example, if a customer's broker-dealer provided day trading training to such customer before opening the account, the broker-dealer could designate that customer as a pattern day trader. And what this means is that under FINRA rules, customers who are deemed pattern day traders must have at least $25,000 in their accounts and can only trade in margin accounts. So that's what we said here before. They're trading in margin accounts as a day trader. And then it says, for more information on pattern day traders and related FINRA margin rules, please read the SEC Staff's Investor Bulletin, Margin Rules for Day Trading. And I'm not going to get into that. I just wanted to point that out, that if you're labeled as a pattern day trader, you have to have the minimum of $25,000 in your trading account, and you have to trade inside a margin account. So make sure, if you do plan on day trading, you talk to your brokerage firm in advance and make sure you're following all the rules. Anyways, guys, that's pretty much all I got for this video. If you enjoyed it, please take a second and drop a like on this video, and feel free to drop me a comment below with any feedback on this. And if you guys are new to the channel, please consider subscribing to be notified of any future uploads. And as always, I thank you guys for watching this video.